Historically, variable rate mortgages perform better than that of fixed rates. There's been studies on it. If you've ever been advised to take a variable mortgage rate, you've probably heard this from your advisor, or you've read it on an article going over the differences between fixed and variable mortgage rates. Indeed, just last week on another platform, I saw a realtor advising clients to take variable rates, as her mortgage broker advised her that historically variable rates perform better. But where does this oft-cited advice come from? It actually comes from this study conducted by Moshe Milevsky, a finance professor at York University in 2001. The study is often used by mortgage advisors, by bank advisors, as a means of demonstrating the appeal of variable rate mortgages over fixed. It's also been called Canada's most misconstrued mortgage study, and the author himself noted in December 2021 that the 20-year-old study may no longer be applicable, and that if he had the choice today, he might very well choose a fixed-rate mortgage. Given that we're still continuing to see this study cited by mortgage advisors, by bank advisors, even in the face of rising interest rates from the Bank of Canada, I think it's prudent to look into the study and see what it actually says.
Did you read it?
No.
So what I want to do today is go over Milevsky's study, take a look at his findings, look at what he says about variable rates versus fixed rates, and then discuss some tips for choosing the right mortgage in the future. Speaking of variable interest rates, the Bank of Canada is set to raise rates in a couple of weeks, which will undoubtedly put upward pressure on Canada's current variable rate mortgages, and we'll obviously have updates out on that rate announcement on this channel. If you want to get those updates, make sure you click like and subscribe, but for now, let's get into this study. Milevsky's study looks to estimate how much money borrowers can save by choosing a short rate, variable rate for our purposes, versus a long rate, or 5-year fixed rate. But how does he do this? Milevsky gathered data from the Bank of Canada from 1950 until 2000, looking at all available 5-year mortgage rates and the month-to-month prime rates that were available for each month for each of the 50 years. Milevsky then paints a picture of two hypothetical borrowers, Shelley Short and Linda Long. Milevsky sets up two hypothetical scenarios where each borrower borrowed $100,000 to be paid off within a 15-year period, starting in 1950. He then looked to see who would pay the most in mortgage payments over those 15-year periods, with Shelley Short having to renew her mortgage rate 14 times, renew it after each 1-year term at the variable rate, whereas Linda Long would have only had to renew twice, each time at the end of her 5-year fixed mortgage rate. But this would give us just one mortgage example, one mortgage that was taken out in January of 1950. But Milevsky then repeats the process and looks at all mortgages that could have been taken out from 1950 until 1985. So he looks at one taken out in January 1950, February 1950, March 1950, and so on, all the way until 1985. Giving him a total of 420 mortgages under study. Milevsky then looks at each of the 420 potential mortgages being taken out and looks to see who paid more in mortgage payments, Linda Long or Shelley Short. The study found that Shelley Short, with her variable rate mortgages, came out ahead 88.6% of the time, saving an average of $22,210 in mortgage payments. This means that out of the 420 potential mortgages taken out between 1950 and 2000, it was best to go with a variable rate mortgage 88.6% of the time. In the name of breadth, Milevsky also goes the extra mile and measures what would have happened if Shelley Short used static payments, and found that 3/4 of the time she paid off her mortgage quicker than Linda Long. But why? Why did Shelley fare so well over the past 50 years? Milevsky goes over what we have talked about on this channel so many times when looking at the yield curve, in that, in general, in most times, it's more expensive to borrow money for a longer period than it is to borrow money for a shorter period. Anything can happen in a 5-year period. You can have job loss, you can have economic catastrophe, higher than normal inflation, etc., etc. So lenders, in general, in most times, charge a higher rate of interest to account for that extra risk than they will when they lend for a shorter period of time. So this is why 88.6% of the time, Linda Long did worse than Shelley Short, who took out 1-year variable rate mortgages which carried with them a lower amount of risk for the mortgage lenders. However, and this is the big however, in spite of the tendency of short-term interest rates to be lower than long-term interest rates, there are situations where this tendency inverts, where short-term rates are actually higher than long-term rates. And this actually just happened in Canada when we saw our yield curve invert, which we've talked about on this channel before. Indeed, Milevsky points out that when there is an inverted yield curve, it is indicative of a situation where the central bank is implementing extremely tight monetary policy in order to fight actual or potential inflation. So, although in normal times we expect to see higher rates for longer periods of time, when we see high inflation, we can see an inverted yield curve, where it actually costs more to borrow on a short-term loan than it does to borrow on a long-term loan. Milevsky points out that this only happened twice during the period under which he is studying. Once after the 1979 Iranian Revolution and the second oil shocks, and the second when the Bank of Canada instituted a zero inflation rate policy. During the period under study, on average, those with variable rate mortgages did 1.35% better, 135 basis points better than those with fixed. In 1981, after the Iranian Revolution, those with fixed rates did 275 basis points better than those with variable rate mortgages. It's definitely not always the case that variable rate mortgages perform better than fixed rate mortgages, and especially not in a period of ultra high inflation or central bank tightening. With all of that said, while Milevsky does note there were brief periods where fixed rate mortgages performed better than that of variable, ultimately he does recommend variable rate mortgages going forward, however with some major caveats. First, understand the risks. Milevsky is adamant in this study that although variable rate mortgages do perform better in the long run, you have to have the cash on hand to handle the swings. You have to be able to make it through those periods where the rates are higher in order to get to those points where the rates are lower. It's all well and good to save money on the variable rate mortgage, but if rates go high enough that you can no longer make the mortgage payments, you're not going to make it through to the other side to take advantage of those lower payments once rates eventually do come down. Second, when rates are low, they tend to go back up.
You are speaking to me.
Third, and I think most important, Milevsky advises that consumers refrain from speculating on the future direction of interest rates and instead focus on their budgeting ability to withstand fluctuating mortgage payments. And I think we've gone over this on this channel many times. The most important part of choosing your interest rate, your mortgage product between variable and fixed, is does it fit your budget? Can you handle the swings if you go with a variable rate mortgage? We've talked about on this channel that in the past 6 months, some buyers, those who bought in early 2022, could be seeing their variable rate mortgage payments go up by $1,000, maybe by thousands of dollars in the near future, not to mention the potential trigger points that are coming down the pike any day now. So to summarize, yes, variable rates have performed better between 1950 and 2000, although there are some big caveats to consider when choosing a variable rate mortgage over a fixed rate. Further, past performance does not guarantee future results. Just because variable rates outperformed that of fixed rates for 50 years in a study that was conducted 20 years ago, doesn't mean they will continue to do so in the future. So, as I always say, and as this study was keen to point out, make sure you choose which mortgage product works best for your budget. Make sure you can handle the swings if rates go up by 3, 4, 5%, which is not out of the realm of possibility looking at Canada's past 70 years of mortgage rates. With all of that said, we'll continue to track the difference between variable and fixed rates on this channel. The spread between variable and fixed rates is likely to narrow even more when we get the Bank of Canada's rate announcement next month, which we'll obviously cover on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.